Jeff, feels like we just sat down on a podcast. What a real pleasure to be back with you.
Likewise. Good to chat with you again, Rob. We should do this every week.
We should, yeah. Well, I actually did want to ask you about something that you did recently. Earlier this year, you put out a paper stating the case for U.S. midcaps, which is one of the portfolios that you manage. And for those who didn't read the paper and would prefer to hear some of the arguments, could you summarize just what went into that paper? What are some of the reasons why U.S. midcaps are such an interesting asset class?
First, I have to thank my colleague Kevin Minus for doing a lot of the hard research behind the numbers and helping write the article, the paper alongside myself. Yeah, so essentially, we were trying to convince ourselves on this one as well, which is why midcaps. Obviously, we thought we had a pretty good idea when we launched the strategy, but we went back and kind of systematically built out the argument and researched the most current up-to-date numbers as well. So for those who haven't seen it, it's available on our website. Feel free to take a look at the case for U.S. midcaps. But I'd say that first and foremost, though, is just U.S. Investing in equities in the U.S. over the last 100 years has been a pretty good proposition. The S&P 500 has been the strongest performing index of most major equity markets in the last 100 years. But also the fundamental reasons. So the U.S., obviously much is made of maybe the current political situation, maybe a little bit more volatile than usual. But I would say most would still agree that this is a country that has a strong rule of law and a strong environment for businesses. Whether you take it all the way to the front end of strongest universities in the world, you talk about the venture capital network that is second to none. So just the business environment is there, but also the laws, the structure, even strong MBA programs, all of the above. So I would say first and foremost, the U.S. is a great place to breed new businesses and have them grow. And then secondly, it is still the largest single unified market in the world by GDP, in terms of being able to have one product or service and scale it across a large domestic market, which is why many global champions started as U.S. companies, because they have a large market to test their products and services in. I would say nowadays, it just demographically and just from a setup standpoint, the U.S. also is looking quite strong. I think Europe is starting to look maybe politically maybe a little bit more fragmented as well. They haven't been maybe handling inflation perhaps quite as well as the U.S., although they're now catching up on that front. But if you look at the GDP growth rates of the U.S. versus Europe, kind of seeing a bit of a divergence since COVID, especially. And then obviously China in past years was talked about as another opportunity or a different place to invest. But certainly since the reopening, or perhaps not so strong reopening, that things there also look a little bit tougher. And then the political environment and maybe more of a top-down kind of controlled view on the economy now is having a dampening effect on the business environment there. So when you put it all together, I'd say the U.S. actually looks like a pretty good market to be in. And so I mentioned demographics, so I'll start going over all these points here.
Everything you've said so far, the setup for U.S. equities, the U.S. is a place to invest. Sure. You mentioned the S&P 500. And I wonder if you can touch more just on the mid-cap side, because it's my understanding, at least, that small and mid-cap stocks have trailed larger cap stocks over the past few decades. So what is it about the mid-cap space that's so interesting in that paper that you put out?
Yeah, so it's very interesting. So I agree with part of your statement, which is mid-caps have trailed the S&P 500, but it hasn't been decades. It's about roughly a decade. Essentially, since the technology companies, the mega tech companies that we've all heard of, have started to do really well in compound. And to be fair, I think they are world-class companies, and probably many of them can continue to compound in their strong market positions, which is why we own a few in our other portfolios. But in the paper, actually, you can see the data yourself. We did 25 years, ended September 30th, 2023. So actually, we did put out this paper a little while ago. Rob, you're only asking me about now. But so anyways, up to that point, and I imagine it hasn't changed too much since, that mid-caps actually outperformed S&P 500 relatively handily in that time period on a cumulative basis, almost double. And the reason for that, I think, is mid caps have always been that sweet spot. And what I mean by that is when you are a very small company, it's hard for you to possess a competitive advantage because many competitive advantages, if you think about it, have some relation to scale. Whether it's a well-known brand, only large companies tend to have big, well-known brands, or scale advantage. Economies of scale obviously requires scale. So it tends to be that as companies grow bigger, they tend to grow into competitive advantages. But the good thing with mid caps is they're large enough that many of them, especially if they operate in niches that are a little bit smaller, they have already scaled up and are quite dominant in the businesses they operate within. On the flip side, mid caps are still smaller than large caps and that still haven't kind of gone into that law of large numbers effect, where it's just really, really hard to grow on a percentage basis because you are so large. And so mid caps are, in our opinion, have close to equal competitive advantages as their large cap brethren, but still much more attractive growth profiles. And so I actually think that statistically, the numbers bear out this kind of deductive argument.
Makes sense. And I'm glad you corrected me on that longer term perspective. If we can move to a shorter term perspective, though, we're recording this about halfway through the year, 2024, early July. And at least relative to the larger cap peers, I think this has been some of the concern that, if you did have concerns about the market, which is funny to say, just given how far the S&P has come so far this year. But I think one of the concerns might be that, hey, it's really just at the top. It's these big mega companies that are really driving returns. And actually that beneath the surface, there's a lot less breadth. And I wonder if that spills over into the mid-cap space where you're spending your time. So all that to say, in terms of a question, can you give us a sense for the current market environment for US mid-caps and what that environment is looking like?
Yeah, that's very perceptive of you to ask, Rob. Yeah, I think there really is a bifurcation of sorts coming out there. So maybe just some stats. So when you look at the Russell Midcap Index, the most common index used for midcaps, 17% of its companies are unprofitable versus the S&P, only 6% of the companies are unprofitable. And I think what that means is there's just more divergence in smaller cap indices. If you go all the way to the Russell 2500, the small mid cap index, that's a full 36% are unprofitable. Anyways, the reason I bring that up and the corresponding ROEs as well, S&P close to 20%, Russell 2500 in the single digits, is that we're having a few champions with really, really high ROEs, really strong business models, kind of dominate the narrative and dominate the performance on a weighted basis. But underneath that, we are seeing, I would say, a lot more of a active market from the standpoint of companies going up, companies going down, as well as investor confidence shifting. And I think that's why, as active managers, it is very interesting to be able to dodge and weave. There seems to be really just one theme right now in the market, which is AI, artificial intelligence, and anything kind of related to that, all the way down to companies that are, building HVAC systems, so kind of air conditioning systems, data centers. Companies like that traditionally trade at 10 or 15 times earnings. I found one recently that traded at 35 times earnings because they maybe with AI have to build more air conditioners. Maybe, but it seems like that's a little bit of a stretch in my mind. But other than that theme, I'd say the rest of the market is quite tentative. There's probably as much up as there is down year to date. And that's probably why you see it in the numbers that the S&P still looks like it's fine, but other indices are a little bit weaker now.
Okay. So far, Jeff, we've talked quite thematically about markets, asset classes, AI as a theme. Wonder if you can bring this a little bit more down to your bread and butter. So the work on individual businesses. And not the last time we sat down, but perhaps the time before that for a podcast, you were on to talk about one of your learnings from last year, which is just the need or the desire to lean a little bit harder on the inductive evidence and the numbers versus the deductive. And I can imagine in a market that's maybe more thematically driven, that becomes more important. And so I'm just wondering, what have you and the team been doing more recently in terms of following through on that learning that you had from last year?
Yeah, so one thing that we've had for a while now, but I think we're using a lot more rigorously. We actually have a dashboard now in Power BI, business intelligence platform, that will show us the fair value ranges every day of the company. And I say every day because although we're not updating the models every day, the models are updating in the background as the discount rates change and as new information comes in. And so, and we're just putting a lot more scrutiny to the companies that seem to be trading at the high end of their fair value range. And that's so kind of to your question of like following the inductive evidence. That is inductive evidence. It's just what are the dollars and cents? What's the historical growth rate, and usually we model kind of in range of what the past is, unless we think there's a reason why it should be different.
Are you saying you're being less tolerant of companies that are really towards the right hand tail of that fair value range?
Yeah, I think that's a fair comment. Although I think we were always intolerant, but maybe even more intolerant now than before. So, for example, two of our recent exits, or three of them actually, probably Copart, CSW Industrials, and Winmark. I think all three are still excellent companies, and in a vacuum or kind of independent evaluation, would love to own all three still. But we exited in each case because we felt like the market was really pricing in either a recent run or just even just blind optimism in some cases. And so what I mean by that is, so Copart, they, as you know, used car prices went up quite a bit during COVID because of the production challenges for new cars. And they've been slowly coming down. But Copart has still had a massive windfall because of the business model of auctioning total vehicles. And what happened is that this was historically, call it, a company that steadily grew their top and bottom line in the mid or maybe high single digits. All of a sudden was growing at 20, 25, 30% a year. And investors got really, really enthusiastic perhaps. And instead of trading this company at 20 and 25 times earnings, again, kind of their historical PE ratio, it went up at some points to 40 times trailing earnings and so on.
Okay, just extrapolating that this might last longer than...
Exactly. And maybe it will, but probabilistically, I think the probabilities are poor. And so we thought, well, is there any other reason that maybe they're gaining more share than before, or they're expanding to international markets and they're getting more opportunities? And at the margin, yes. But for every argument, yes, you could also find an argument, no, some things are changing about the business negatively as well. For example, the CEO recently changed, and they kind of brought in more of a professional manager as opposed to some of a family-run business, which statistically is unfavorable. So that's a case where, like, yeah, we just thought the market was maybe a little bit too enthusiastic. And I can talk about CSW and Winmark as well. But essentially, just valuations got too far ahead because of a short-term trend, and we just believe the longer-term track record, I suppose, of how these businesses have performed.
Can I ask you to put on that inductive hat and talk about some other holdings like Amphenol or KLA, where perhaps similarly you're seeing this outsized growth rate with respect to that AI theme? And so how are you dealing with those in the sense that, yeah, those are still names that we hold on to and in quite big size within the portfolio?
Well, we have trimmed both recently. Probably similar reason, just the valuations look a little bit stretched. KLA on a traditional PE ratio actually doesn't look too bad. I would say there is more around political risk.
Can you talk a little bit just about what KLA is and what that risk might be?
Yeah, so KLA is the world's largest manufacturer of process control equipment. So when you manufacture semiconductors, some of these processes are very tight, literally like single atom width sized processes. And so you need to control these processes within very, very small tolerances. And you need specialized equipment to do that. Apparently, the industry sells something like 15 or 20 billion, at that, probably 15 or so $billion of process control equipment a year, of which roughly half is KLA's equipment. And being the largest provider of that equipment, they have more money to invest in R&D and keep their technological lead. So that's what KLA does. And the benefit is AI chips require some of the most cutting edge manufacturing techniques. And so KLA is continually selling more and more of their most cutting edge equipment, obviously the highest priced, highest return equipment to customers. So that's why KLA has done so well. But a couple things that give us pause. One is China has actually become the largest geography of sales, even after recently the Biden administration restricted some high-end semiconductor technology exports to China. Even just the fact that KLA and others are selling what are called trailing edge equipment, so equipment used to make chips from 10 or 15 years ago. That alone is still driving a large demand in China, probably because I think that country is trying to become a little bit more independent of from a semiconductor standpoint. And so I just kind of worry that regardless of who wins the next election, that generally the political environment in the US is becoming more unfavorable for semiconductor exports to China. So that is a part of it. And the second part, too, is just plain old cyclicality. Again, if you believe AI is definitely going to keep growing at the current pace for forever, then yeah, KLA is a fine stock to own at the current valuation. But if you put any probability of that maybe not being the case, then again, the valuation gets more expensive. And Amphenol is actually a great example of a company that, so they make interconnects. So if you plug your iPhone into the wall, chances are Amphenol made that little interconnect in the iPhone to help you charge your phone. Or an Android phone. They're agnostic, of course. But that was a case where they actually suffered from, call it a standard industrial recession that's kind of come out to the last 12 or 18 months. But the valuation did not suffer, actually. It increased. And so that was another case of the markets maybe, a different case where the market was not believing the inductive evidence. And in this case, we decided to trim because the valuation just started to look a little too heady.
Can we go back just a second? Because we are recording this the week after the presidential debate between Joe Biden and Donald Trump. And there is an election in the US coming up later this year. In fact, it's a year of lots of elections, but the one in the US really being the biggie. And so you talked a little bit about how that might influence KLA. From a bottom-up perspective, but also from a portfolio constructive, how do you weigh this stuff? Listeners have often heard from us, hey, prepare, don't predict. But what does that look like day to day as you think about different outcomes that could come to bear, both in the short term, but then also longer term, thinking about the portfolio?
So the biggest thing with risks like elections is the work we do. I mean, is things that our listeners or our investors probably don't see because we actually made no action. Rather, we've gone through the portfolio company by company and thought through, okay, what might happen if there is an election that leads to a change in administration or not a change in administration. And in many cases, I'm glad to say that we have picked companies that are probably pretty resilient in any election outcome environment. And a few may be impacted at the margin a little bit more with one or the other. Or in some cases, obviously, all companies will be impacted relatively equally, such as if, I think tax cuts or tax increases are on the table for both candidates. So obviously, that would just impact all companies. But for things such as like what we talked about with KLA or more generally kind of import tariffs and so on. So when we look through the portfolio, it is actually more services weighted than product weighted. So we don't have as much import exposure. And secondly, very few of our companies who import products and then sell them or incorporate them into another product and then sell them onward are competing against a domestic manufacturer. What I mean by that is take a company like Shark Ninja, for example. They manufacture vacuum cleaners, blenders, and those sorts of things. They compete against vacuum cleaners that are also manufactured outside of the United States or blenders also manufactured outside the United States. So if someone like former President Trump gets in again, well, and he puts as he has threatened, this 10% tariff across the board, I think all vacuum cleaners will just be 10% more expensive. And I don't think Shark Ninja actually would be at a disadvantage, other than perhaps there's a dampening effect on vacuum cleaner demand across industry versus, I don't know, paying for a cleaner to come to your house. I don't know, maybe that's cheaper now. But I guess my point being is the biggest thing we've done is go through company by company, think through the risks as part of our ongoing risk management exercise. And we've realized that our portfolio is actually quite resilient and is prepared and diversified for many different scenarios, including different election outcomes.
And Jeff, just to go back to the beginning, because I can understand among listers, there might be consternation with the uncertainty associated with an election and what that might look like for different companies. But we started at the beginning with this idea of why US midcaps. And so I'm wondering, as you look at either the portfolio today or the setup today, what has you most encouraged?
I think the other work that we've done quite a bit over the last 6 to 9 months is trying to reduce the overall risk in the portfolio. And the largest risk we actually identified 6 or 9 months ago was not election or any of these macroeconomic themes. Obviously, interest rates have been a topical theme for a while. Inflation. It's actually a straight up valuation, and if you measured it on a kind of a diametric price earnings basis, the portfolio on a forward basis 6 months ago traded over 20 times. And today it's at 17 times, even though the portfolio is actually up year to date on a performance basis. And a lot of that is hard work below the surface to sell a Copart or a Winmark or some of these Trim and Amphenol and find other interesting ideas to replace them with that don't look as expensive on our discounted cash flow basis, which also generally correlates to a lower traditional metrics as well. And so I think that has me quite encouraged that we have what we still think is a world-beating portfolio of competitively advantaged companies, ROEs of 19% on average, which is kind of equivalent to the S&P 500. Let's call it blue chip mid-cap. But you have it now at about a 4 or 5 forward multiple point discount to the S&P 500, or maybe even more. I don't track that every day, but I know the S&P just keeps going up and up. So I imagine the earnings aren't quite keeping up. So I think that's what has me encouraged, is that when you go outside the S&P 500, you certainly should go active because a lot of these companies are unprofitable. But if you decide to choose to go active with Mower, we think of a robust, resilient portfolio that should stand the test of time in many environments that we're currently worried about.
Well, Jeff, that's a great way to sum it up. A statistically advantaged portfolio of competitively advantaged companies run by a pretty sound portfolio management team. And so, Jeff, thanks so much. Thanks for coming on again so soon after your last time, and look forward to the next.
Thanks, Rob. Great to chat with you again.